In today's video, we'll delve into two unstoppable growth stocks that investors should consider adding to their portfolio during a market dip. But before we dive in, here's a question for you. What if the next big market sell-off was actually your ticket to massive gains? Stick around to find out how seizing the right opportunities during a downturn could set you up for long-term success. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. First, let's talk about Alphabet, the parent company of Google. Alphabet is a behemoth in the tech industry, and its dominance in digital advertising makes it a cornerstone of many investment portfolios. With its leading position in the internet search market, Alphabet has been able to capitalize on the massive digital advertising market, generating billions of dollars in revenue. Over the past 12 months alone, Alphabet has reported a staggering $328 billion in revenue. That's almost $1 billion in revenue per day. What's even more impressive is that roughly 75% of that revenue comes from advertising. Alphabet's ability to grow this enormous revenue stream over the years is a testament to its strong business model and innovative culture. The company has averaged a 19% growth rate in quarterly revenue over the last decade, which has helped its stock generate a compound annual growth rate (KGR) of 20% since 2014. This remarkable growth has made Alphabet a favorite among long-term investors. However, what makes Alphabet particularly attractive right now is its valuation. Despite its strong fundamentals and consistent performance, Alphabet's shares are trading at a price-to-earnings (PE) ratio of 25, which is significantly lower than its 10-year average of 30. This means that investors have the opportunity to buy a high-quality growth stock at a discount compared to its historical valuation. There are a few reasons why Alphabet is trading at a lower valuation, including an ongoing antitrust lawsuit brought by the federal government. While legal challenges are always a concern, it's important to remember that Alphabet has faced regulatory scrutiny before and has managed to navigate through it. For savvy investors, this uncertainty can be seen as an opportunity to accumulate shares at a discounted price. And if the broader market experiences a sell-off pushing Alphabet's shares even lower, it could present an even more compelling buying opportunity. One of the critical aspects that make Alphabet a formidable player in the stock market is its diversified portfolio of products and services. Beyond its dominance in the search engine market, Alphabet has expanded into various sectors, including cloud computing, autonomous vehicles, artificial intelligence, and even health technology. Google Cloud, for instance, has become one of the leading cloud service providers globally, competing with giants like Amazon Web Services and Microsoft Azure. This diversification not only provides Alphabet with multiple revenue streams, but also ensures that the company remains resilient against market fluctuations. Moreover, Alphabet's commitment to innovation cannot be overstated. The company has consistently invested in research and development, pouring billions into projects that could shape the future of technology. This forward-thinking approach is evident in its endeavors such as Waymo, its autonomous vehicle division, and DeepMind, its AI research lab. By staying at the forefront of technological advancements, Alphabet continues to create value for its shareholders and solidify its position as a leader in the tech industry. Another factor that adds to Alphabet's appeal is its robust financial health. The company boasts a strong balance sheet with substantial cash reserves, which provides it with the flexibility to invest in new growth opportunities or weather economic downturns. In addition, Alphabet's relatively low debt levels compared to its peers make it a less risky investment, especially during uncertain times. Alphabet's brand strength is also a significant asset. Google is not just a search engine, it has become a part of everyday life for billions of people around the world. This brand recognition and loyalty give Alphabet a competitive edge, allowing it to maintain and grow its user base with minimal marketing efforts. In a world where brand equity plays a crucial role in consumer choices, Alphabet's strong brand positioning is a vital component of its ongoing success. But before we proceed, here's a question for you. What do you think drives a company like Alphabet to keep growing, even when the market gets a little shaky? We want to hear your thoughts in the comment section. Now let's shift our focus to Visa, ticker V. Like Alphabet, Visa is another powerhouse that has shown impressive growth over the years. Visa's shares have delivered a 10-year compound annual growth rate, CAGR, of 18%, outpacing the performance of the benchmark S&P 500 index, which posted a 13% KGR over the same period. This strong performance is a result of Visa's simple yet effective business model. Visa operates a global payments network that facilitates hundreds of billions of transactions per year, about 750 million transactions per day. Each time a transaction is processed on Visa's network, the company earns a fee. This consistent stream of fees has translated into billions of dollars in revenue for Visa. Over the past 12 months, the company has generated $35 billion in revenue, and due to its asset-light business model, a significant portion of that revenue is converted into profit. Visa reported nearly $19 billion in net income during the same period. Despite these strong financials, Visa's stock is currently trading at a price-to-earnings ratio of 28, which is below its 10-year average of 34. This suggests that the market is undervaluing Visa's growth potential. Similar to Alphabet, Visa is facing an antitrust lawsuit, which has created some uncertainty among investors. In June, a federal judge rejected a proposed $30 billion settlement between Visa, MasterCard, and merchants, raising questions about the potential costs of the litigation. While legal battles can be unsettling, it's important to keep in mind Visa's long-term growth prospects. The company's network is ubiquitous, and its services are integral to the global economy. As digital payments continue to grow, Visa is well-positioned to benefit from this trend. Once the legal issues are resolved, Visa can refocus on its core business of facilitating transactions and delivering value to shareholders. Visa's business model is particularly appealing because it is largely insulated from the risks that traditional banks face. Unlike banks, Visa does not take on credit risk or hold large amounts of capital on its balance sheet. Instead, it acts as a toll booth, collecting fees for every transaction that passes through its network. This model not only generates steady revenue, but also leads to high profit margins, making Visa a cash-generating machine. Moreover, Visa has a significant opportunity to expand its business as the world increasingly moves toward a cashless society. With the rise of e-commerce and mobile payments, Visa is well-positioned to capture a growing share of the global payments market. The company is also exploring new technologies, such as blockchain, to enhance its services and stay ahead of the competition. Visa's international presence is another key strength. The company operates in over 200 countries and territories, giving it access to a vast and diverse customer base. This global reach not only drives growth, but also provides Visa with a hedge against economic downturns in any single market. Additionally, as emerging markets continue to develop and adopt digital payments, Visa stands to benefit from the increasing volume of transactions in these regions. Furthermore, Visa's commitment to innovation is evident in its efforts to enhance its payment solutions and expand into new areas such as digital wallets and fintech partnerships. By staying at the cutting edge of payment technology, Visa ensures that it remains relevant in an increasingly competitive market. In addition to their strong market positions, both Alphabet and Visa offer unique advantages that make them attractive investments during a market dip. Alphabet's vast array of products and services, including Google Search, YouTube, Android, and Google Cloud, provide multiple revenue streams that diversify its income. This diversification helps Alphabet weather economic downturns better than companies with a more concentrated revenue base. On the other hand, Visa's business model benefits from its global scale and network effects. The more consumers and merchants that use Visa's network, the more valuable it becomes, creating a virtuous cycle of growth. This scale also provides Visa with a competitive advantage, as it can invest in technology and security to enhance its offerings, making it harder for competitors to match its level of service. When considering the pros and cons of investing in these stocks during a market sell-off, it's crucial to weigh their long-term growth potential against any short-term risks. For Alphabet, the potential downside includes regulatory challenges and the ongoing antitrust lawsuit. However, these risks are counterbalanced by the company's dominant position in the digital advertising space, its impressive revenue growth, and its undervalued stock price. For Visa, the primary concern is the uncertainty surrounding its antitrust lawsuit, but with its strong financial performance, consistent revenue growth, and leading position in the global payments market, Visa remains a compelling investment. The company's ability to generate high profits with a relatively low level of assets makes it a highly efficient business that can continue to deliver strong returns for investors. Ultimately, both Alphabet and Visa have demonstrated their resilience and growth potential over the years. By buying these stocks during a market dip, investors can take advantage of lower prices and position themselves for significant gains as the market recovers. It's important to remember that investing in individual stocks always carries some level of risk, so it's essential to do your own research and consider your risk tolerance before making any investment decisions. The table provides a detailed comparison of Alphabet and Visa, highlighting their strengths as resilient growth stocks. Alphabet, with its massive $328 billion in annual revenue, generates the bulk of its income from digital advertising, contributing to its impressive 19% quarterly revenue growth rate and a consistent 20% compound annual growth rate, CAGR, since 2014. Despite regulatory challenges, Alphabet's current price-to-earnings ratio of 25 suggests it's trading at a discount compared to its historical average, making it an attractive buy during market dips. Visa, on the other hand, demonstrates its strength with $35 billion in annual revenue and a solid 8 to 12% quarterly growth rate. Its asset-light business model enables high profit margins, with a net income of $20.25 billion over the last 12 months. Visa's current price-to-earnings ratio of 28, below its 10-year average, indicates potential undervaluation. The company's global reach and the increasing shift towards a cashless society position it for continued growth. In essence, the table showcases how both companies' robust financials and strategic market positions make them strong candidates for long-term investment. investment, particularly during times of market uncertainty. To wrap things up, Alphabet and Visa are two unstoppable growth stocks that offer compelling opportunities for investors, especially during market sell-offs. Their strong market positions, consistent revenue growth, and potential for long-term gains make them worthy additions to any investment portfolio. But before we wrap up, let me ask you this. If you could pick just one stock to hold on to for the next decade, what would it be and why? Comment your thoughts below. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more insightful content. And remember, this video is for informational purposes only and does not constitute financial advice. Always do your own research and consult with a financial advisor before making any investment decisions. Thank you for watching Simple Investing Secrets, and we'll see you in the next video.